Hello and welcome to TheoTrade. My name is Doc Severson and this is the Theo Night Report for Thursday, September 15th. Here's a chart of Apple. Today, Apple really drove the action as we had a 3.4% move in Apple just today, and that's on top of the big move that we had in Apple yesterday. So it's tapped on about 8 points to the upside, which for Apple is a pretty hefty move. You know, it's just a little bit under 8% move to the upside in just 3 days. Now, if we go out to the weekly chart, what we can see is one of these classic moves that we had, this trend line with a series of lower highs and equal lows, right? So this is showing actually a descending triangle pattern, which is a bearish pattern. Again, this is one of those patterns that everybody sees and everybody starts to load up in the shorts. But then what we saw was the break above here. So first of all, this started with a higher low. So that was the first clue. And then as that broke above there, that had a change in polarity of the weekly chart. All right. And so we break above this trend line and then we come back and retest it from above. This is a classic move. And then what this does is this attracts all the late to the party shorts, saying, there it goes again. Apple's breaking down again. And this is where people that missed this move and missed this move and missed this move finally say, you know what, I'd like to get short on Apple. And this is why this creates these short covering moves, because too many weekend bears jumping on board at the very last minute, way after when the move has already matured. Now, if we look at Apple on a larger time frame, just a monthly chart, what we can see is that this move that we've had here recently, since really the beginning of 2015, so this has been almost 2 years in the making, is very similar to what we went through back in 2012. Again, everybody predicting the end of the world for Apple, and then it came back from there. All right, so longer term, this is still following this monthly trend to the upside, right? Now, just as an aside, any company that builds a temple to themselves, usually that marks the high water mark for them. So Apple's spaceship campus that they have built as a monument to themselves might end up marking the high for this. But for right now, Apple is still in that major consolidation pattern. And just within that pattern, we can see some dramatic moves. And this is what we're seeing. I mean, look at the range of this thing. It goes anywhere from 135 down to 90. That's a 45-point swing inside of here that Apple could be trapped within this range for quite some time, and we still have plenty of opportunities. Nonetheless, you know, a 10-point or 10% move or so in the course of the last few days is going to produce some effect on the major indices. So this is, of course, really cooking the Qs right now. The Qs are right back to just about where we dropped off the other day, right? So after all the volatility last few days, all this has served to do is just to basically get things cooked up again. However, the way that I look at charts right now from a fractal perspective, I also look at energy, the available energy for a chart. And what I see there is range consolidation, or range contraction leads to range expansion, but we're also still coming off an exhaustion move right now. So there's no guarantee that just because we rallied above here over the last few days, that this is going to go anywhere. We just may be stuck in a pattern for quite some time here looking forward as the election cycle works itself out. There is so much indecision right now. It's hard to see that the markets are going to be that prescient to be able to look past the election and be able to find certainty in this. The other thing to note as I switch over to the S&P 500 is that we are seeing this pattern play out that I brought up the other day. Now, after the initial move lower at the beginning of the year, this energy rebounded to the tune of about 310 points to the upside, right? Created a sideways consolidation pattern. And then what we saw from there was the Brexit move, right? Which dropped about 120 points or so to the downside. And then that rallied up about 200. So we're seeing these slingshot moves. First of all, back in the wintertime, now in late June and into July, we saw that slingshot move. And now we're seeing the same thing happen all over again, but just on a smaller basis, right? So we keep seeing these moves. Maybe this one's going to be good for about 100 points or so, but ultimately a rising pattern like this will break to the downside. The question is, when is this going to break to the downside? I think this is what everybody is thinking right now, which is one reason why we're seeing markets go higher. There is so much skepticism right now. There is so much disbelief. And generally, all of that has got to be unwound from the market to get to the point of euphoria before we can get a reasonable drop. Again, I would love it looking out here at the S&P. I'd love it, absolutely love it if we sit there and did a reset all the way back down to 1600. That's going to scare a lot of people, but it's going to give us a lot more opportunity and flush out some of these toxins that were created through central bank policy. But just because I would love to see something like that happen doesn't necessarily mean that it will happen. So as long as central banks continue flushing things through there, we may continue grinding higher in this unbelievable skeptic market right now that we have. That is just going to continue punishing shorts until there are no shorts left to find, and then we may get our move. But right now it's hard for me to see how markets are going to get any form of momentum. Again, similar to what we've seen for the last 2 months, right? So all of this stuff, it's hard for me to see how we're going to get any momentum right now with the amount of indecision that we have in the political cycle, number one. Number two, with the monetary cycle that we have right now, where obviously even the Fed doesn't know what they're doing and what to do about it right now. Every time that the Fed is primed to make some type of decisive action, we get something happening like a couple of weeks ago where we had a lousy jobs report that coming in well below consensus. So right now we only have about a 12% chance of any kind of Fed activity happening next week. When I say Fed activity, meaning a quarter point rate hike, right now there's an 88% chance that it's going to stay pat where it is right now. That should take the drama out of there, but that doesn't mean that the Fed is done though. They can certainly interject some type of leaning in terms of when they're going to do something. Really, if they don't do something in September in terms of a rate hike, it's very unlikely that they're going to do so at the next opportunity, which is going to be the 2nd of November. Are you kidding? Do you think that they're going to raise high rates in just a few days before the election? I very much doubt it. This is why I think we're looking at a much higher chance of any kind of monetary policy being changed. And this is what everybody else is saying as well too, with the Fed funds futures right now, showing about a 39% chance of a rate hike coming up in the December cycle. Certainly after the election, be able to sneak one in before the end of the year during the lame duck session. So with all of this in mind, with all of this background and backdrop and just talking about markets and where markets are going and everything like that, one thing that's at a premium right now is any kind of foresight in terms of what to trade in terms of this market. I mean, we are literally crawling along the edge of the abyss right now, waiting for some type of precipitous drop from here, which is making premium selling very, very dangerous right now. Not only are the volatility futures very low, but there's just not much premium out there really to pay for the risk of selling something right now. So even though it seems like such a bargain right now to be able to sell credit spreads or anything like that right now, the risk of movement is enormous over the near term, but you're not being paid for the risk that you're selling. So to me and to the rest of us here at TheoTrade, really the way to go is stick to limited risk spreads where we're going for a 1-to-1 ratio on these. It takes so many variables out of the trade in terms of the vega or the sensitivity to implied volatility, as well as the time decay for that as well too. So we can simply focus not only a little bit on direction, but also just the normal swings back and forth of price volatility will allow us to hit our target more often than not with these trades. So I'll leave you with that thought. Keep things simple until we do have a little bit more clarity, and we may not get clarity until we actually get much, much more volatility coming into play over the course of the next 2 months. If it's going to happen, it's going to happen in September and October. It always seems to occur during these 2 months. Just when you think things are fixed, the volatility kicks in again. So don't bet against volatility in the near term. Thanks for listening, folks. We'll talk to you soon.